Well, folks, thanks for having me. Can everybody hear me okay? Yes. Yeah. Awesome. So my job today is to walk us through some of the macroeconomic indicators that are happening that might affect the supply chain, but also try to distill where the data have left us in the wake of the Biden administration into the beginning of the Trump administration, and now thinking about where tariffs may take us, and as well as many other policies. So we're going to focus a lot of today later on tariffs and what might happen, but the data have not completely revealed themselves yet. And so for macroeconomists, there's a lot of mystery land about, and Omar did a really good job of this, about the length of time we're going to see tariffs in their current form, the volume that will stick around, and what countries will be most affected. So China, Vietnam specifically are two that we're watching very closely because those two have very strong links to our supply chain management across many, many industries in the United States. But we'll talk more, again, at a macro level because Omar did such a good job at the micro. Sorry. So let's walk back. This graph starts us with thinking about where the Trump administration was able to gain some house money when they took over. So if you look at the labor market in the United States, we look at two major phases. One is the blue line, which if you put everybody who was working in the United States in November 2007 and make that number equal to 100, that blue line traces out where we went down into the Great Recession and then emerged from it just to the point of recovery. It took 78 months to get back to the same number of people working in the United States when we started the downturn in November 2007. The black line represents the same idea, but starting in January 2020, where you can see the sharp cut going into the pandemic, the rise up in recovery, and then this expansion where we're about 5% above where we were in January 2020, seasonally adjusted on a monthly basis as of March 2025. So when you add all that together, and well, I'm sorry, it's been updated from these graphs, but basically the trend of that black line is continuing to rise. Now, why that's important is this. There's been a lot of talk that tariff policy on top of a bunch of different policies that have come out of the Trump White House will actually create recession forces. Unless that black line starts to curl back toward that red line in earnest, we will not have a second declared recession in the United States. Okay? We need the labor market to fade to actually have that happen. And the Trump administration, regardless of the rhetoric, they know that. So we're watching very closely to see how job changes, maybe based on what we've seen in terms of tariff policy, start to affect the American economy in a way that recession fear goes up. And I'll come back and talk about this in about 5 minutes. Now, one of the key aspects of where the Trump administration has been hoping for more help in their vision has been the Federal Reserve actually moving interest rates down. So the Federal Reserve is going to announce, if they haven't already, I should have checked my news this morning, you should hear today that the Federal Reserve made no change to interest rates. Part of that is because of the data I'm going to show you here. That blue solid line on this graph from January 2007 forward on a monthly basis is the core personal consumption expenditures price index. This is the favorite price index of the Federal Reserve and is meant to encapsulate almost everything we buy, if not all of it, at home, and the percentage change in the basket of goods and its costs that we buy at home looking back 12 months. So the data on here are from February, and that 2.8% means it costs 2.8% more to buy everything we buy at home, more than it did February 2024, but core means we took food and energy prices and products out of that basket. So it makes it more core spending. So you can see the evolution from January 2007 forward, not much change right until the pandemic, and then about 8 or 9 months after the pandemic, we started to see a creep up, and then we saw the rockets take off in terms of prices. But we've been descending since basically the middle of 2023 and through most of 2024, but then we've seen this flat period, which should be circled now here, where we saw a bit of a stumble, which suggests that the warm labor market is going to push price pressures up because if people continue to get jobs, continue to get raises, they're going to continue to consume. And that's going to put pressure on the demand side of the economy to not have the fade in inflation we originally were hoping for. So part of the game with the Federal Reserve has been, well, we lowered rates to sort of say we did our job and we don't want to keep rates too high. But we haven't continued to lower rates because we're concerned that all we'll do is exacerbate that inflation pressure that's already kind of boiled into the American economy. So if you start to stack tariff policy on, which in a few minutes I'll tell you has nothing but inflationary pressure inside of it, the Federal Reserve is being very careful about reducing interest rates, even though the Trump White House would love that because it preserves jobs in their mind, which is the number one way we're going to go into a declared recession if those jobs numbers start to turn toward that red dotted line. We're watching very closely how, that shaded area where all the red dots are, that's the current forecast from the Federal Reserve about where we're going toward the end of 2027. They want to engage in interest rate policy that's going to shape us through those red dots. Now, if we look at what has been going on in our equity markets, and then we'll come back to a deeper discussion of interest rates, investors have got a lot more nervous in the last few months. But I wanted to show you a long view of the S&P 500 because it's very tough to make big generalizations about where investors are if you don't think about where they've been. So this is from January 2000 forward, so the year 2000. You can see the 3 recessions we've had since January 2000 in those shaded areas. And you can see that the Great Recession, if y'all were investors during the time of the Great Recession, you had a lot of stomach aches starting in September 2008 through about the middle of 2010. That looks absolutely dwarfed now vis-a-vis what we've seen since the pandemic, even though the pandemic has been a very roller coaster ride in terms of we shot up in 2020, 2021. When rates started to go up, we moved back down a little bit and kind of went in what you think of as a mean reversion. And then we had another great bull market until earlier this year. And then there's that little hook on the right-hand side, which I don't think I actually outlined here, but you can see that. Well, people get nervous in equity markets when they lose money. They expect to make money. So there's a lot of stomach aches with that blue little hook on that blue line. But we forget how much money has been made in the equity market since or before that. So the equity market, specifically the S&P 500, between December 2019 and December 2024 increased almost 85%, okay? Regardless of the little wobble we saw in 2022. So we give back about 10 or 11% and everybody loses their minds. But if you were in basically the S&P in early 2020, you still got a lot of gains on the table. We have to assume some of that's profit taking, but a lot of it's based on uncertainty. The orange line is the 6-month moving average of the S&P. And generally speaking, at least water cooler wise at your local investment house, they will tell you that when the blue line crosses the orange line, it's called a death cross. It means we're moving toward a bear market from a bull. We'll see. You can see that there. Okay, it did circle. That's good. I thought I saw that. Now, in terms of interest rates, one of the things we're watching closely as macroeconomists is what's happening with the blue line, which is the difference between the 10-year Treasury rate and the 3-month Treasury rate. That spread is indicative of the profitability from lending money. So when the blue line goes below 0, it suggests banks, credit unions, and savings banks are going to struggle more to profit from lending. When it's above, they gain a little bit more. And the black line is the evolution of the federal funds rate, or what the Federal Reserve sets, and what they'll talk about today when they release the news and hopefully say that they didn't change anything so it doesn't make me look stupid up here later. You should not see much change. So it'll continue to kind of flatten out, at least on the far right-hand side, right? But here's the point. You can see that when the black line started to move down, the blue line started to move up, because when the Federal Reserve changes rates, they change short-term rates and starts to pull the cost of funds for lenders down. So bankers also like to see federal funds moving down. Equity markets like to see federal funds moving down in terms of the rate. But right now we're kind of in a point of stasis. You can see, though, that when that blue line goes below 0, a recession is normally coming. We have been living with what you could think of as an inverted yield curve for some time without a lot of recessionary pressure. That recessionary pressure may be somewhat exacerbated now based on administrative versus economic policy. Okay, so if we look at an interest rate forecast, and if you start thinking about what investments might take place in terms of inventories, what investments might take place in terms of new facilities, the interest rate environment is something you want to watch. So hopefully you can see that green shaded area. It should start the first quarter of 2025. These data come out of Fannie Mae, which is the government-sponsored organization that buys secondary mortgages from lenders when they lend in a conforming fashion. So it's basically like a huge hedge fund for mortgages that the government sponsors. This blue line is what their current forecast and what the actual data are to the end of last year, looking forward for the federal funds rate or what the Federal Reserve is going to do. So the supposition is we will see some rate cuts. But these data, and this is tough for me to say, are about 8 weeks old, right? Which sounds like it might as well have taken place in the Middle Ages, right? Given what we've seen in the last 8 weeks. So we need to be cautious to watch how this rate forecast changes. But a lot of it is predicated upon the idea that we will see some sort of middle ground struck in terms of tariff policy, recognizing that we're going to have inflation pressure and potentially jobs pressure on the other side of continued draconian tariff policy. And the Federal Reserve will then kind of continue on its normal path toward what it sees as a long-run medium. Now, this is the 10-year Treasury rate, and this is actually elevated a little bit from the last forecast, but the bottom line is that Fannie Mae does not see much change in the 10-year Treasury rate over the next couple of years. So these data are quarterly from 2022 forward to the end of 2026. And that tick up, or the idea that we're not going to see much of a change there, even if the Federal Reserve is lowering rates, is because investors are getting very nervous about longer-term inflation. So A, when you saw the inflation pressure kind of continue around in that graph where we looked at the core PCE data, and you think about how tariff policy might also kick up medium to longer-term inflation, if longer-term rates kick up, that's going to keep business rates up, mortgage rates up, and generally going to have some suppression effect on the growth of things like commercial real estate. So we're watching that closely along with the mortgage rate because the 10-year Treasury and the 30-year conforming mortgage rate tend to walk hand in hand. If that starts to affect housing markets, that also changes the evolution of construction of residential properties in the United States. So as a macroeconomist, my number one price or my number one indicator is what's going to happen with interest rates, or is the blend of interest rates that I tend to watch. So this is a very important graph in terms of how macroeconomics works. Okay, we want to see these descend, and descend in a way that is something we expected rather than episodic. And if you can typify anything in the last 8 weeks, it's been very episodic. Now, talking about the Middle Ages and a forecast, here's another one. Every quarter, the Philadelphia Federal Reserve interviews 40 forecasters and says, hey, what's your outlook over the next few years for a bunch of different economic variables? And I pick out 3 that I think are relatively good summaries on top of the interest rate forecast I just showed you of where the economy is going, or things to track that suggest, okay, these are pretty decent indicators of the major ideas in the macroeconomy that I want to watch. The green shaded columns, which are labeled new in green, are the latest forecasts, or the ones that are using the end of year data through the end of quarter 4 2024 to then publish a forecast in the middle of the first quarter of 2025 for the next few years. And the first stop on the left is real GDP growth, or what you think of as income after inflation and the percentage change on an annualized basis. So the previous column is the previous quarter's forecast. And you can see that these forecasters actually were a little bit more, and they knew that Trump was coming in the White House in this forecast. They did not know that in the previous quarter's forecast. That they got a little bit more optimistic about growth in 25 and 26, less optimistic about 27, and they had not yet done 28 in the previous quarter. That's also true for unemployment in the sense that they expect a relatively warm labor market to stick around, and the core PCE data I showed you before in those red dots basically following through. Now, what they did not know is they did not know the level of tariffs that were coming. They did not know the level or volume of deportations that were going to take place that could affect local labor markets. And they didn't know the totality of the uncertainty that was going to be imputed by the Trump administration once they got in power. Okay? What we have seen, which should come now, is that we have seen an elevation of the probability of recession, but we have not had, let's say, a general sense that the recession is inevitable given the current state of affairs. We have a couple new forecasts that came out in the last 10 days that suggest maybe it's now 60 or 70% at the far right-hand side of the distribution of having a recession take place in the latter 2 quarters of this year. But for the most part, forecasters are still somewhere about 1/5 a chance or maybe 1/4 a chance next year. But the recession probabilities are rising, and they should be. What you do not want when you're thinking about macro policy is imputing uncertainty into an already uncertain place with a lot of geopolitics that are problematic, with already supply chain issues that are problematic with our major trading partners just on the political side, whether or not there's a major conflict happening or not, and with some confusion about whether or not inflation has stuck around in a way that is now structurally changed because of the pandemic and its shadow versus something that's more cyclical. And that's really the game at the Federal Reserve in terms of interest rates, is that has inflation changed in such a way we will not be able to fully cure it or bring it back down to this 2% sort of inflation expectations threshold anytime soon. Okay, so that's kind of the major macro outlook, or at least overview, given that those forecasts are, like I said, about 8 weeks old. We're going to now look at some manufacturing indicators, and when I had to give the slides, these have changed a little bit, and I'll try to describe those as we go along. In terms of looking at petroleum prices and what we think of as core consumer prices, this is the evolution over the longer haul. One of the big questions I get asked when I work with manufacturers is how tied are consumer prices to gas prices? And more completely, how tied are gas prices at the pump to West Texas Intermediate crude or to Brent crude in terms of global oil prices? And the answer is not too much. And the reason I say that is because another question I get asked a lot is, why do we take energy prices out of our basket of goods, or energy products and services out of our basket of goods, when so much of what we buy at home is tied directly or indirectly to energy products? And that's a great question. The idea is that we're not getting any more information besides something that's episodic, so we try to think about core when we do policy. But you can see here that the correlation when things are rising tends to be somewhat mixed over time. So the 2 points of this graph are, one, there really is not a strict correlation between how energy prices evolve and their transmission through supply chains in terms of core consumer prices, but both have been descending on that far right-hand side, suggesting that we've seen some of the original inflation pressure from the pandemic fade. And you should be able to see that now here where that arrow is. They're seeing a fade. Now, these data are through February this year, not March or April yet, okay? Now, we're seeing a little bit of a curl up in the latest data, but not surging up. If we look at manufacturing producer price indices, we're going to see something that over the long haul is going to be, I think most of us know this. This is the price, think of this as the price index that manufacturers pay for their inputs in total. And then we're going to break it down with thinking about the purchase price of metals. Then we're going to think about what they pay for machines, what they pay for industrial commodities, and then construction costs. And notice how they tend to follow each other regardless of where you're at or what you need in your supply chain. But they've all elevated from a really long-term trend of very slow, steady, predictable evolution of pricing. What tariffs will do will exacerbate the far right-hand side of those graphs. We've already seen it start to curl up because we've seen prices rise through some supply chains already in sort of thinking that the tariffs are going to stick around, but it's been very slow to date. Should we expect producer prices for manufacturers to rise relatively quickly? And the answer is it will depend on whether or not tariffs stick around in their current formation and in what products and in what level of change. So there's still a lot of mystery on this, but for right now, you're going to see a lot of manufacturers are thinking, wow, if these tariffs stick around and prices are already elevated, we're going to have to cover ourselves a little bit, or we're going to have to find other vendors and other ways of doing business. And Omar did a great job about talking about some of the options that are out there. He basically said anything I would advise. Okay? You're going to watch a lot of transition in manufacturing the longer and longer these tariffs stick around. And part of it is we already have elevated price from where we were, let's say, 5 or 6 years ago. This will exacerbate it. And you can see where all that action's happened since the pandemic. We look at new orders. Again, these data are about 8 weeks old. New orders have been trending down into some flatness over the last few quarters and last, let's say, 6 or 9 months. But the latest data in March actually saw new orders pick up and actually also saw inventories pick up. So the two major indicators I tend to watch when I think about forecasting the economy that come out of manufacturing that add to whatever I might say about the macroeconomy are new orders and inventories. So we've seen both of those pick up. We will see if that continues. But part of that could be a dubious change in the sense that if I think tariffs are coming and I can gain access to lower cost goods now, I will do new orders, play those out, and start to inventory them. Now, as Omar said, how many POs are actually coming in total is going to be the big question. It's so hard to watch the monthly data and make any assessment of trend. So we're going to watch closely how the 6-month moving average is actually starting to curl and telling a story the trend is changing. Again, so much of that will depend on what happens with more certainty in terms of administrative policy around tariffs and other things, including labor force. Okay, so what should we be thinking? Well, hopefully you already know this, but I'm going to walk through this because these are the things that really will tell the story of the long-lasting effects of tariffs as we see them evolve. Tariffs are indirect sales taxes. The consumer will pay that price at some point. However, the burden, or who actually has to shift their cost structure or their price structure, depends on the elasticity of demand. So the more elastic the demand or more responsive consumers are to prices, the more the producer tends to have to take on the burden of that to keep prices stable. The less elastic, the more consumers will pay. So we're watching closely to see how much of that actually happens, and furthermore, how responsive producers in the United States are. Because one glimmer of hope, if you want to say it that way, for manufacturing is you might actually see current excess capacity kick online in certain industries because now demand will be there. The Trump administration has not really talked about that much. They've talked in more like the grand slam wins of we're going to have car manufacturing come back and we're going to have a brand new Detroit show up somewhere in the South. We're going to have steel manufacturing in Bethlehem, Pennsylvania be reinvigorated by all this. The economics around that happening while all of us in this room are alive are very low, okay? However, we might see excess capacity kick in the short to medium term, see some gains from this on the producer side, but consumers are going to pay for that. And if they start to contract demand, that's when the pain really is going to start and start to move all the way through supply chains, all the way back to other countries. And that's kind of the larger game in town. But like I said, so much depends, we already said that. The key is, what is the end game? So one of the things that's been bizarre, because from a macroeconomic standpoint, if you look at the history of macroeconomics, the worst way to run an economy is to play pinball with the economy in terms of just hitting the flapper and hoping I know where the ball is going to go, right? We don't like to do that. We want to shape the way consumers and businesses think and say, hey, this is where we're going to be in 6 months. If I know where I'm going to be in 6 hours, I'm going to hold. And hold is bad for an economy's growth. So we have not been told what the end game is. What you can think of as the end game probably lives in 2 buckets. One, politically it will be a win, especially for a lot of red states, if some manufacturing is either augmented or repatriated. The South and the Midwest are the 2 places where that most likely will come given the cost of labor and what already exists. It will not happen on the coasts, okay? And I'm from Northern California. The idea that California is going to be this manufacturing super hub is 0 chance in the medium term, okay? It might happen in the super long term, but we would have to completely rearrange the cost structure of living in California to pull that off, even though we do have a relatively large economy in that state. Okay, so that's possible endgame 1. The other endgame is to create so much uncertainty that a collective of about 25 or 30 individuals will be able to profit wildly off of equity market movements that play off of that uncertainty, and I'll pull the rug out from everything when I think we've kind of taken all the juice out of the market, and if everybody bought in, it'll start moving back up and we'll gain again. That is also being floated around some macroeconomic circles that at this point you should start watching if there are so-called value stocks and how those value stocks are potentially connected to manufacturing and to tariff structure to where a reversal of it will then ignite a growth pace in that stock again. So watch for that hypothesis to start showing its face. If we look at the trade balance, this is the difference between imports and exports on in current dollars, because I wanted to show that real fade on the right-hand side. So in February, when tariffs started to show their face, we saw a real change in the nature of how we were buying imports. We were trying to buy them as fast as possible before things went sideways. And so we saw a real surge in imports, and we also saw some countries pushing back on exports simultaneously. This has come back in the March data, but we're watching this closely to see how much we're seeing a lack of relief in the lower value of the dollar. So whenever you have tariff policy and you start to make imports more expensive, and you start to see the dollar start to fade in value, that should ignite more export activity unless other countries are going to retaliate and or stop taking American goods because demand for them have stopped. So you may have seen the news, probably the poster child for that happening is Canadian liquor stores and their government run to pull American products off the shelf and then say buy Canadian instead, right? That is a microcosm of one thing that might happen that can exacerbate that downhill slide. This is not good for the American economy when this happens, okay? This means consumers are paying more and we're not selling as much outside in a very quick fashion. And like I said, it's slightly reversed in the March data, but we need to watch trend. We're also watching what's happening with commodities prices. And I want to show you commodities prices in 2 ways because there's 2 sort of things that are shaping themselves in commodities markets. Omar talked about copper and let's say precious metals in general, but in thinking about more industrial metals. I just gave a sampling here of metals in terms of showing you a mixed bag of some of the changes in prices. So these are in current dollars and the percentage change from 1 year ago. You can see gold and silver have started to really go up as well as aluminum. A lot of that has really happened in the last 4 or 5 months with the idea that if we have uncertainty around inflation and furthermore we have uncertainty around tariffs, we're going to see more buying in those precious metals because we're concerned about buying them now while it's relatively inexpensive, stockpiling them and waiting, and that demand acts like a self-fulfilling prophecy and starts to move prices up. Now in real terms, if we look at what's happened in terms of inflation-adjusted terms, and we look at the longer haul, which is the better way of thinking about it, and that's why I'm showing this, is because I really want you to think not, oh wow, gold went up 15 bucks yesterday. How is it doing against inflation over the long term? And in fact, gold has had a really good run over the last year and 5 years, but most of the action has been in the last year. You can see that red column, which is the 5-year growth after inflation. The 1 year is almost exactly equal. Why are people buying gold? Well, it could be because they're thinking, again, they want to stockpile it for industrial use, or is it because they're concerned about inflation? And how does that start to transmit itself to other precious metals? And gold has this really weird part or role in our lives. We tend to watch that, but in the other metals we're seeing in silver, tin, and aluminum, we're concerned that those are going to be core tariff focused, and buying now is better, but when you do that, you're basically starting to charge the price up already. So we're watching to see how that starts to also change manufacturing outcomes over time, especially if your intention is to use those in your manufacturing processes. Okay, so now what I want to do is I want to look at what's happened with inflation for imports over the long haul and then the CPI. So if you look at consumer prices, which is the black line, Consumer prices going from January 2000 forward really showed very little change until the pandemic. We saw a little bit when we went into the Great Recession. That you could say that inflation was one of the starters of the Great Recession, even though the mortgage market really is what sunk us in the end of the day. But import prices have been pretty flat for a long period of time, and some of this is a function of relatively, focus on free trade in such a way we're trying to knock down import price instability. We saw it lift a little bit going in and out of the coming out of the pandemic, but not as fast as consumer prices overall. Imports do not play an enormous part of our lives. So think about GDP. Imports and exports, what we think of as the trade balance, is usually less than 10% of GDP when it's all said and done. And that's over a very long period of time. Okay? It's not one of the key drivers, but it is something that, again, imputes a lot of uncertainty when it's volatile. And furthermore, it makes people think whether or not I should consume. And then it starts to affect the larger portion of gross domestic product and starts to drag down a reason to hire. So that sort of domino effect is what we're concerned about, and we're watching to see if we see that blue line start to curl up in earnest, because this is not really in a tariff environment through February. It will be come April, May, June if we don't see some change in the current policy. So we're watching that very closely to see how that starts to change. Finally, I want to look at jobs in manufacturing as kind of a way of thinking about, not thinking about the inbound inputs, but thinking about how hiring may start to change. On the long haul for manufacturing, we've seen openings for manufacturing hiring really surge after the pandemic, same time frame, basically the early 2000s through February 2025. You can see that it was really following the business cycle. We went into recession, there was a downturn in openings. We saw a pretty steady growth going toward the end of 2018 and early 2019, then it started to fade a little bit. That usually is a harbinger of recession. The other reason I'm showing this is because forecasters tend to use jobs growth in manufacturing as a forecasting tool. And then we saw it rise up, basically almost following what happened with inflation in some ways, and then starting to fade. This is actual hires from those openings. So in the case of this time, we actually saw hires above and beyond because we were just trying to find people very quickly, and then we saw a reorientation of it in the 2010s, and now we've had this gap where we way over advertised for jobs versus who we intend to hire, but both have been fading. Now, will that continue? And if it does, how much more pressure does that put on labor markets in general? That'll be let me go back and let me just make sure I make my final point. That'll be the big deal, looking and seeing how manufacturers really start to react to all the other cost pressures. Do they start to fade who they hire? And how does that start to exacerbate the negativity in forecasting models and really thinking about how it starts to spread itself through supply chains and hiring beyond? So, to summarize, the macro forecasts as of the first quarter of 2025 were actually pretty good, but they are going to start to fade. And there's going to be this big sort of intellectual battle over who's got the better forecast and who's going to see the end game sooner than later, but we are seeing some split. So one graph I didn't show you because it really showed its face over the last 4 weeks is that the New York Fed and the Atlanta Fed both have high frequency forecasting models for each quarter we're in. They were predicting completely opposite outcomes for the first quarter of 2025. One was saying we'd grow about 2.6%, the other one saying we would grow by negative 2.8%, and the actual first outcome was 0.3% negative. So right smack dab in the middle. So a lot of confusion in forecasting models, especially those that are high frequency, but that split's going to continue. The tariff policy will continue to have a lot of uncertainty. That's going to exacerbate problems with investor confidence. It's probably going to keep growth in equity markets suppressed and will likely keep growth in expansion and hiring somewhat slower than it would have been otherwise. Now, so much of that depends on its resolution and more like, okay, here is the end game. We've now made the deals we think we want to make, and now we're on to something else in this structure, and then we can all start to adjust to what we think is now the medium-term structure. Finally, that interest rate watch is critical. We're going to watch and see what happens. Like I said, the Fed should have done nothing today based on the data and based on their sort of what they've been doing as a way of keeping investor confidence and sort of saying this, we're going to stay on this track until we know better otherwise. But watch how interest rates start to change in other markets that aren't driven by the Fed as ways of investors saying, hey, I need more risk relief. I need yields to start rising. When those yields start rising, that means there's downward pressure on the economy. We're going to get in trouble as those rates start to rise. On manufacturing, we should expect that there's going to be some change in the way that manufacturing happens in the United States on the other side of this. We actually should see some stimulus in certain pockets. Will it be a reformation of the way the manufacturing happens in the United States? No way. Next, we want to think about, will consumers just simply bite the bullet when the prices come and change? But we have to assume that inflation is going to be exacerbated, and the consumers are going to pay for that in the end. We are watching commodities markets, as I showed you before. Do those commodities markets give us any sort of future inkling as to what's coming, in the sense that it suggests, okay, now we're starting to see that this is going to start trickling through supply chains and are going to stick rather than go in and reverse themselves? And for economics, the key is structural change. If it's cyclical and very short cycle, this is something that says, okay, we're just going to take a punch in the face and then we're going to recover and we're going to move on. So a lot of forecasts are saying it's going to be a short recession and it's going to happen in quarter 3 or quarter 4 this year. Because once the recession hits, that'll force the hand of getting more deals done and actually showing more cards in terms of what the end game is. And then investors, consumers, and businesses will all make an adjustment. We will see if that happens. We're watching very closely to see if we don't have at least some markets that are giving us some inkling. And then we've seen those indicators for manufacturing falling, but we are going to see them curl up in the short term. We're already seeing that. It will not last. We need to see whether or not we are going to see some change in tariff policy, again, that gives you more certainty. But we might actually see, like I said earlier, some pockets of manufacturing in the United States pick up. But we should not expect it to be a structural change for the positive as being advertised. That is a misconception about the way economics works. Okay? So folks, with that, thank you. The outcomes are going to be mixed for at least the next 2 quarters, and as we fade closer toward, or when we get closer to the end of 2025, depending on what happens over summer, will really tell the tale of whether or not we're going to get closer to recession. Right now, it's more of a mixed bag in terms of where we see policy going. Hopefully, logic will prevail. We will see. But thank you.